In recent years, the economic survey has become perhaps the best repository of data and trends on the Indian economy. This year's survey was no different, talking about near-term issues like fiscal consolidation, medium-term issues like the tax base, and longer-term issues like climate impact on agriculture. Here to talk about some of that here on Bloomberg Quint, Dr. Arvind Subramanian, the Chief Economic Advisor of the country. Dr. Subramanian, thanks so much for taking the time to speak to us. Dr. Subramanian, my first question is immediate. Now, since you presented the economic survey, the 10-year government bond yield, the new 10-year, has moved up another 15 basis points, Dr. Subramanian. The market is sending a very clear signal. One, it does not believe that the 3% fiscal deficit target should be pushed out by another year. And two, in more real terms, there isn't going to be enough demand and perhaps enough liquidity next year to support the kind of supply of paper that could come in. Is that message being heard in Delhi, Dr. Subramanian?
Well, you'll find out on day after tomorrow whether that message is being heard or not. Government is committed to fiscal consolidation, and well aware of its situation in the markets. The Secretary has clarified what the situation is for this year, and we will be, the government will be very responsible next year.
But Dr. Subramanian, your survey talked about modest consolidation, and this is not the first time you have taken that kind of line, sir. If that is the track we have to follow, then we perhaps need to move away from committing to 3% and never meeting it, would you not say?
Well, you see, remember, my view on this has always been that investing numbers with a sanctity, as an economist, I can't really, justify these things. I think governments consolidate, as this government has done steadily over the last 3-4 years, because it believes in consolidation, it believes in macro prudence and macro stability. And that will continue. I don't think one should be, obsessed with any one number for debt or deficits. So I think it's completely consistent to be, absolutely prudent and responsible, and, undertake a path of steady consolidation without being necessarily wedded to any one number.
Dr. Subramanian, good afternoon. This is Menaka here. I'm wondering if the government will draw courage from the tax data that you've put up in the survey, both in terms of the addition to the direct tax base, which you quantified it as about 18 lakh, and the new taxpayers that have joined the indirect tax base under GST, which you quantified as about 34 lakh. Now, whilst these may not be contributing directly to the revenue collection at this point in time, given where they are on the threshold front, does this give the government courage to put out more ambitious tax targets there, and therefore feel more comfortable with spending over not just this budget, but the next few budgets?
Yeah, look, I think that in the medium term, even next year, perhaps beginning next year, I think one should expect, greater revenue buoyancy, both from direct and indirect taxes. And that will no doubt be factored into account as the government, thinks about its overall fiscal and macroeconomic stance. So absolutely, it is very encouraging, these trends which we documented in the survey.
Is there any further data that suggests to us, how much more in terms of tax collection, or how much more aggression in terms of tax targets would be justified by these additions to the tax base?
Look, if you look at the GST this year, we've put out some new numbers in the survey, which shows that GST this year, if you look at it properly, do all the necessary accounting correctly, that GST has grown by about 12% this year, which reflects a buoyancy which is greater than, true historically. Going forward, I think this will only improve over time, but I think we need to wait just a little bit more for the system to stabilize before we can be, super confident about any precise estimate that we want to make. And as the Finance Minister has said, we're in the process of stabilizing it, and but it's going to take maybe a quarter or two before we can be confident about where it's going to stabilize at.
Dr. Subramanian, I just want to move to the growth front, and in particular your chapter on the savings and investment slowdown. I think there were 2 points you made there. One, that it should not be assumed that we will automatically move back to the levels of 2007 perhaps. And two, the nature of the investment slowdown in particular, the balance sheet nature of the investment slowdown, mean that the rebound could be perhaps very slow. Do both of those indicate that even India's potential growth rate or the rebound in growth that is being anticipated would probably stop at close to 7.5% rather than move back up above 8 or closer to 9%, sir?
You see, remember, for the coming year, we're saying 7 to 7.5. You know, if, as the early signs are showing that private investment has turned the corner, if that can continue on the back of some important policy reforms like the resolution and recapitalization, and the world economy is doing well. So a combination of, you know, the actions on the twin balance sheet, a pickup in world demand, means that investment could come back and we could start kind of edging our way back to, you know, 8 plus. Of course, that would be, you would also have to factor into account what happens on oil prices and, you know, possible, you know, challenges on the downside from oil prices. So all of these factors are going to determine, you know, how quickly we can get to 8%.
But Dr. Subramanian, what is your own assessment of potential growth at this stage? I think the last number we got was from an RBI study which was close to 6.7 to 7%, I think. If that is the kind of potential we're talking about under the current scenario, then anything above that will be inflationary as well.
Yeah, I think that, remember that calculations of potential are very, very tricky. I've done these for a living in the past, and these are very, very sensitive calculations. I mean, you have to make all these assumptions about what you think total factor productivity is going to be, what participation rates are going to be. You know, my own sense is that India's potential is, you know, somewhere, you know, under reasonable assumptions, is somewhere around 8 plus. And I think the more we get investment up, the higher obviously that potential can be. But I don't necessarily assume, because remember, we still have a lot of excess capacity. So if growth reaches 7.5, 8, I'm not at all sure that that's going to start leading into higher inflation necessarily. So potential output calculations are important, but I think there's too much uncertainty around those estimates for us to be really confident about saying that at some level inflation will start picking up.
In your estimate, Dr. Subramanian, do you believe that the government ought to move now and take action in being able to boost the investment side of things? Or is it simply a matter of time before animal spirits revive, whether on account of declining surplus capacity? In short, the question I'm trying to ask you is that do you think maybe a tax rate cut for corporations is what it will take to revive animal spirits if it's going to take too long a period of time? Otherwise, for the natural process of things to restore order?
Look, I think one of the most important determinants of weak investment in the past has been the twin balance sheet challenge, right? I think with resolution and recapitalization, those are major policy initiatives, you know, aimed at reversing that investment decline. I think I would caution against this, you know, you've done something and then you say you need to do more. I think the policy agenda for this year would be ambitious and ample if government just, you know, completed all the things that it started. You know, support agriculture, stabilize the GST, and privatize Air India, and complete these resolution recapitalization efforts as well. So, I mean, I'm warning against the kind of temptation of saying, you know, you need to do more and more and more. I think there's a lot that's being done. Finishing them could bring back the animal spirits as well, along with a cooperative world economy.
Dr. Subramanian, you know, a question on this, you know, sort of banking reform process. You've said that, you know, of the 4 hours, the 4th hour is what needs to be focused on. You talked about, you know, perhaps, looking at the words, it suggested that you want a privatization of banking as opposed to privatization of individual banks. That means greater private participation in the banking sector. Is that what you were hinting at? And that may be achieved by just not allowing some of the weaker banks to grow that rapidly by virtue of perhaps lower growth capital allotment?
No, I think that, in my view, at least reforms need to encompass both kind of shrinking banks that are fundamentally unviable over time, gradually, maybe different marketing niches for different banks, but some sense that fundamentally unviable ones need to be shrunk. That's on one side. And on the other side, what I mean by greater private sector participation is also on, for the good banks. I think, going forward, see, one of the things we've realized, the experience of the last 5-10 years, the infrastructure boom, what I call the era of stigmatized capitalism, I think we've realized that public to private lending has proved very toxic. So going forward, if you don't want this experience to repeat itself, maybe there should be less public ownership of that, because you'll get less public to private lending. So I do think some roadmap for greater private sector participation would help, at the appropriate time. It has to be done at the appropriate time, but I think that should not be ruled out going forward.
Sorry, Dr. Subramanian, can you explain that less public to private lending aspect? What are you saying, that public sector banks should not be lending to large infrastructure? Is that what you're suggesting? Didn't get that, sir.
Yeah. During the period of the infrastructure surge in the mid-2000s, we had a lot of public sector banks lending to private sector companies. Now, when those loans turned sour and we found ourselves with this twin balance sheet challenge, we found that it was very difficult to exit from that because of this, this zeitgeist of stigmatized capitalism. That is that, any attempt to get out of this always is open to the charge that, you're letting the promoters off the hook, etc., etc. So if we don't want that experience to repeat itself, I think ipso facto it means that we probably should have less public to private lending going forward, that, the private sector should be funding needs should be met by a variety of other sources, bond markets, but also more private sector participation in the banking system itself.
Dr. Subramanian, there's a wealth of data in your economic survey. There are several more points we'd like to question you on, but in the interest of time, we'll narrow it down to just two. The first one is you've devoted about 3 pages in the end of chapter 1 on equity risk premia and how the price to equity ratio of Indian equities is converging with US equities, even if the underlying fundamentals of the two economies are not similar or nowhere close to same. Is there a message here? Are you simply making observations? Or is there something we should take away from this in terms of how you understand the role that the equity markets are playing in the larger economy and whether something needs to change that role?
No, I think that it's more, kind of analysis with some, lessons as well that all of us must draw. I mean, we know from the history of, financial markets and asset prices that, the higher they go and the more out of line with historical trends they are, the more likely that you get correction and mean reversion. So it's just a call for greater vigilance, because I think if some disruptive corrections were to happen, that could have, costs for the economy. We have to guard against that. I mean, it's a call for vigilance.
I'm sorry to try and expand on that word vigilance, but obviously the equity markets were quite surprised to get that kind of attention in your economic survey, and they were wondering whether this is a message saying there is the need for tempering the overheatedness of markets, if one may call it that, and whether this is a precursor or a warning that long-term capital gains tax might be something that you are in favor of when it comes to equities. We don't know whether it's in the budget or not. So what's your view on that?
I have no views on long-term capital gains or whatever. It's just a kind of analysis of asset valuations, and what and how they're different from what's happening elsewhere, and what is it that we should be watchful about. I mean, remember that we've always known that governments should never second guess markets and market valuations, because nobody knows what the true valuation is. But we know from the lessons of history that the higher they go, the more likely mean reversion happens, and we have to make sure that we guard against any kind of disruptive corrections.
Dr. Subramanian, last question on the...
Thank you very much.
Can I throw in one last question on the formal non-farm payrolls data, Dr. Subramanian? You didn't venture into the controversy of job creation or how many jobs are being created, but you've put a higher number to formal non-farm payrolls. What is the message there, Dr. Subramanian?
Yeah, it's a stock calculation. Because we have access to GST and EPFO data, it's just something that's very novel and surprising and interesting about the Indian economy, that the level of formal employment is much greater than we believed. But it's a stock calculation. It's not a calculation on how many jobs were created in 2017-18 or 2016-17. I just want to clarify that. Yeah.
All right, Dr. Subramanian, thank you so much. That's Arvind Subramanian giving us some insights into a very deep survey in any case.
Yeah, I thought the key takeaway really was him suggesting, or not suggesting, but saying that the government should stick the course and not get tempted into, a tax rate cut of any sort. Just an interesting message, to get 2 days before the budget. Not that it means anything. The finance minister may very well think otherwise.
True. Thanks so much for watching Bloomberg Quint. That was a conversation with Arvind Subramanian.
बढ़ते समय के साथ बढ़ती सुरक्षा का वादा।